What if I told you there is one single reason the housing market is completely frozen right now, and it has nothing to do with greedy sellers, lazy builders, or even mortgage rates? Stick with me for the next few minutes because once you understand this one thing, everything about the current market will finally make sense. Here's what nobody is talking about loudly enough. Right now, roughly 51% of all active mortgages in the United States carry an interest rate below 4%. About 20% of homeowners are sitting on a rate below 3%. That sounds like good news for those people, and in one way it absolutely is. But here is the dark side of that statistic, and this is the one reason the entire housing market has essentially stopped functioning. Those homeowners are trapped. Not by circumstance, not by bad luck, but because they are trapped and there is no financial incentive to sell. Think about what that actually means in real numbers, because the numbers here are genuinely shocking. If you locked in a mortgage at 2.75% back in 2021 on a $400,000 loan, your monthly payment was somewhere around $1,633. If you sell that house today and buy another one at current rates around 6.5%, that same $400,000 loan now costs you $2,528 every single month. That is nearly $900 more per month. Every month. For 30 years. Federal Reserve researchers actually calculated the average financial penalty of trading your old low-rate mortgage for a new one at today's rates, and they put that number at over $65,000. $65,000 just to move. And that is before we even talk about the fact that home prices themselves are near all-time highs. So you are not just absorbing a higher rate, you are absorbing a higher rate on a more expensive house. The math is not aggressive, it is punishing. So what does a rational person do when the math looks like that? They stay put. They do not list their home. They do not call a real estate agent. They sit in the house that might be too small, in the neighborhood they have outgrown, with the extra bedroom that stopped being a nursery and started being a storage unit. Not because they want to stay, but because a spreadsheet is physically preventing them from leaving. And here is where this gets interesting, because this one decision, multiplied across millions of households, is the entire reason the housing market looks the way it does right now. The Atlanta Fed studied this effect specifically and found that this rate lock-in phenomenon reduces the probability that any given homeowner lists their home by somewhere between 21 and 23%. Researchers at the FHFA estimated it has directly suppressed approximately 1.7 million transactions that would have otherwise happened under normal market conditions. That is not a rounding error. That is a structural removal of supply from the market at exactly the moment when first-time buyers are out there desperately trying to find something to purchase. Active inventory is still sitting about 17% below 2019 levels. Months of supply is hovering between 3.3 and 3.8. A balanced market needs 6 months of supply. We are not even halfway there, and the reason why is almost entirely this one thing. Here is what makes this particularly cruel for anyone trying to buy right now. The shortage is not because homes do not exist. The homes are there. Millions of them. People are living in them, locked in by golden handcuffs they did not even know they were putting on when rates were at historic lows. So the buyer looking for a home today is not competing against a broken economy or a construction collapse. They are competing against the invisible force of financial logic keeping existing owners from ever becoming sellers. Supply looks thin not because supply disappeared, but because supply is frozen in place. And the downstream effects of this are real and they are personal. The average first-time buyer in America right now is 40 years old. In the early 1990s, that number was 28. That 12-year gap is not a generational attitude shift. It is the direct consequence of a market where qualified, financially responsible people simply cannot find available homes at prices they can manage. First-time buyers now represent just 21% of all purchases, a record low across 44 years of tracking data. The historical normal is 40%. These are not people who gave up on saving. These are people being systematically excluded by a supply problem rooted in one very specific financial incentive keeping sellers off the market. Now you might be thinking, okay, but what happens when rates eventually come down? Will not sellers finally unlock and flood the market with listings? And yes, partially. The lock-in effect does gradually loosen as life happens. People have children, change jobs, get divorced, retire. The share of mortgages below 4% has already dipped from its peak of about 65% down to roughly 48% today. That slow release is real progress. But a Bankrate survey found that 37% of homeowners say they would not even consider selling unless rates fell below 5%. We are not there yet. And even if we got there quickly, here is the counterintuitive problem. A fast rate drop does not simply heal the market. It potentially triggers a wave of pent-up buyers all flooding back in simultaneously, crashing into a supply base that still has not recovered. More demand, same thin supply equals prices spike again. The cure, if it arrives too fast, risks repeating the exact same problem that created this mess in the first place. So where does that leave you if you are trying to make a decision in this market right now? It means you have to stop waiting for the market to feel normal before you act, because this is the new operating reality for at least the next several years. The lock-in effect fades slowly. Supply rebuilds slowly. This is a 5 to 10 year structural adjustment, not a headline moment where everything snaps back. What that means practically is that your decision needs to be grounded entirely in your own numbers, not in hope that conditions improve by next spring. If your total monthly housing cost lands below 28 to 30% of your gross income and you plan to stay for at least 7 years, buying can make sense. If the numbers do not clear that bar, they simply do not clear it, regardless of what anyone with a commission on the line tells you. The housing market is not broken because of greed or politics or bad luck. It is frozen because millions of perfectly rational people are doing the perfectly rational thing and refusing to give up the cheapest money they will almost certainly ever hold in their lifetimes. One mechanism. One financial trap. And until that trap gradually releases its grip, the rest of the market, buyers, sellers, builders, everyone, is just waiting around it. If this video helped you see the market differently, drop a like because it genuinely helps. Subscribe if you want to keep getting the honest math on what is actually happening out there, and I will see you in the next one.